Hello and welcome to the Financial Services Expo. I'm Andrew Montlake, and with me now I have Stuart Wilson, who's the B2B Marketing Director at More to Life. Hello Stuart.
Hi.
And also Dean Mirfin, who's the Technical Director at Key Retirement. Hello Dean.
Hi there.
So we're going to talk about the older borrower market. How real do you think the issue is for older borrowers? Stuart.
It's a very real issue. I look back to some research that More to Life did last year into this, and we created a report on lending in retirement, borrowing, attitudes to borrowing in retirement. And what we found is that 57% of people aged 55 and above said they expected to enter retirement with some form of debt. Now that could be mortgage debt, personal loans, credit cards, etc. So people are expecting to enter retirement in debt. They are more comfortable with having debt in retirement. In fact, we found nearly 2/3 of those same people said they actually wanted to see more products designed specifically for them, for their age group and for their needs in retirement. So certainly there is a growing demand amongst consumers in their 50s and 60s who are looking forward through retirement and expecting to need some form of borrowing to help them with their retirement needs. So it's a growing issue. But it's an exciting one from a lender's perspective and from a funder's perspective, because it means there's room for innovation, for product growth, to deliver even better solutions for consumers.
Yeah. Dean, anything to add?
Yeah, I think one of the challenges as a broker that we fundamentally have is, from an equity release perspective, we're meeting a lot of needs at the moment, but there are needs outside of our core market which we can't meet. LTVs are a big challenge. How can people who need to borrow more borrow more? But what we're increasingly seeing are not issues around, will somebody lend to me till I'm 80 or till I'm 90? Yes, that's getting better. But criteria hasn't really changed yet in terms of, we see people who are a very good lending risk in our view, in their 60s, in their 70s, good income, but where the attitude to lending to older borrowers hasn't changed. They're still being lent to as though they're 30 in terms of how risk is being viewed. And I think the challenge for older borrowers, as Stuart will probably profess as well, is they see things differently. They know they're a higher risk because they're older, they face different issues, and they actually are quite upfront about that, whereas a younger borrower will probably not want to even think about risk of not being able to pay their mortgage. So older borrowers are actually more readily able and willing to talk to lenders about how they take on some of that risk with them and work together on how they can lend.
And do you think lenders have sort of taken that on board? Is there still a dearth of innovation in that area?
Not enough yet, not enough. We're starting to see lenders now change their attitude to drawdown, as in pension drawdown, and they're starting to get a framework to how they treat that, because of course there's no guarantees there. And so we're starting to see that emerging, but still, certainly bigger lenders especially are still very much about, if it isn't guaranteed, we're worried. And that's what we need to see start to change.
So do you think brokers are making the most of the whole equity release piece, or is it still quite a mystical?
I think it's certainly changing. I think there was once a point in time where the equity release world was seen as very niche, almost a little bit weird in some respects. It's changed beyond that now. It's a very much as a specialist advice area, and those that are working in it offer a very particular form of advice. It is a specialist advice. It requires a specialist qualification. It's interesting. The FCA have made an announcement just today about this very issue, and they're looking at changing the rules around the types of qualification that we require to work in this market. And that follows on from another announcement they made just recently about looking at the whole regulatory framework that this market is controlled by. So we see many more brokers entering this market or looking to enter this market. It's certainly not a market for the dabbler, because it's far too specialist. You need to be very cognizant of all of this is a rapidly evolving market, so you need to be keeping pace with that. And at the very least, you should be talking to your clients about retirement lending opportunities, which would include equity release, but not just be restricted to that. But if you're not qualified to do it, there are firms out here, out in the market, that can offer the specialist advice that you can refer to. So we would encourage more advisors to enter this space, either to deliver the advice that their clients need, or at the very least to be talking to them about the opportunity and the transformational effect that retirement lending could have on their own personal circumstances, but referring them on to specialist firms for the ultimate advice.
And Dean, so a challenge for older people then, just in a normal type of lending. Obviously you've got affordability issues after retirement. What are the main issues there? Have you been doing some work around that?
I think one of the big issues that lenders are not necessarily struggling with, but actually clients do, is certainly obviously in those early years of retirement, the majority of people we see are couples. And one of their biggest concerns is the event of either death, and in particular the death of the main earner or the person who's carrying the most pension wealth. And they're very upfront about that in terms of what happens. But interestingly, they're not worried about losing the home if that happens.
Right.
What they're most worried about is how will you as my lender treat me when it does happen? In other words, if you're just going to treat me as though I've deliberately stopped paying and oust me as soon as possible, I don't like that. And what we are starting to have are some very good real conversations with lenders about different triggers, meaning that they will actually treat people differently. I.e., if you can't pay because a spouse has died, we will look at maybe giving you a longer period before we would take any action in order to give you time to adjust. But therefore structuring the products in a way, be that through LTVs, etc., where they can allow that to happen, i.e. they may only lend 50 or 60% max LTV, so there's lots of headroom in the equity if they need to allow a longer period of default. So I think there's some good things happening, but it does come back to the fact that clients actually know what the concerns are and they're asking lenders to work with them on how they overcome them.
So it seems to me the lenders need to engage a lot more with people like yourself who are the experts and listen to the client.
Yeah.
Well, thank you very much, both of you. Thank you, Stuart, and thank you, Dean. Thank you very much.